Tomorrow morning, the world's biggest silver buyer disappears for 8 days. And what happens in that blackout will decide whether this 2026 bull run turns into a historic squeeze or another Hunt Brothers style smash. China is about to shut the lights on the physical market, while Comex sits at 103 million ounces registered against up to 500 million ounces of paper claims just 12 days before March delivery, and most people still think this is just another holiday. I'm OG John AG, and in this video, we're going to zoom in on the silver market, not the headlines. Why the last time Asian liquidity went thin, silver crashed 35% in one session. How 1.8 billion ounces of paper got dumped in a day on Comex. What 8 days without China really mean for spreads, slippage, and smashdowns. And how to position so you're not the liquidity when the algorithms come hunting. Segment 1. China pulls the plug on the silver market tomorrow, Monday, February 16th. The dragon goes dark. Here's the shutdown schedule that matters for silver. Shanghai Stock Exchange, closed Feb 1623, reopens Tuesday, Feb 24. Shanghai Gold Exchange and Chinese commodity markets also close that entire stretch. Hong Kong, half-day Monday, then fully closed Tuesday, Thursday, Feb 1719, back Friday, Feb 20. Singapore, half-day Monday, closed Tuesday, Wednesday, Feb 1718, back Thursday, Feb 19. That's 8 consecutive trading days with no mainland Chinese participation and only patchy Hong Kong, Singapore flow in between. Now plug in what China is to silver. Controls 60-70% of global refined silver output. Most silver is a byproduct of base metal mining there. As of January 1st, 2026, Beijing tightened export rules. Only refiners producing 80-plus tons a year can export, knocking hundreds of smaller refiners out of global circulation. Translation: China is hoarding silver, deliberately bottlenecking how much refined metal can leave. So when China closes, you don't just lose some volume, you lose the dominant physical hub at the exact moment the West is trying to pretend silver is plentiful. Segment 2. Comex. 103 M ounces versus up to 500 Maller's claims. Now let's talk about the Western silver casino you actually see on your screen. On Comex right now, registered silver, deliverable metal with a for sale tag, is about 103 million ounces. March open interest represents between 400 and 500 million ounces of paper silver. Inventories are draining at roughly 785,000 ounces per day. Do the simple math across the 8-day Chinese blackout. 8 days x 785,000 Oz, 6.28 million ounces drained before Shanghai even reopens. That would take registered down to around 96 and 97 million ounces. Then you still have 3 more trading days before first notice on Feb 27th. Another charmer 2.35 million ounces out the door at that pace. 93 to 94 million ounces registered heading into delivery month. Now map that against delivery scenarios. If 40-50 million ounces stand for delivery, what we saw in January, Comex limps through March, but you're left with maybe 43-54 million ounces heading into April, a crisis, just delayed. If 80-100 million ounces stand because physical buyers smell blood and insist on bars, Comex cannot meet that with 93-94 M registered. The system breaks or is forced into overt rationing. One more twist. JP Morgan issued 99% of January silver deliveries, 8.1 million ounces via 1,624 contracts, one bank acting as the primary spigot between paper and metal. That's not a free market, that's managed rationing. Comex silver is a fractional reserve system. Several people think they own the same ounce, and we're walking straight toward a date where someone finds out there isn't enough to go around. Segment 3, January 30th, the 35% silver crash autopsy. The last time Asian liquidity went thin, silver didn't correct. It detonated. On January 30th, silver opened around $115. By the end of the session, it traded near $71, about a 35% crash in one day, worse than the Hunt Brothers wipeout in 1980. Gold fell 12%, its biggest single-day percentage drop since the 1980s. Mainstream narrative: Kevin Warsh Fed Chair nomination spooked the market. Reality inside the tape: CME hiked margins. Gold from 6% to 8%. Silver from 11% to 15%. That forced highly leveraged longs to either wire in massive new capital immediately or dump positions at any price. They mostly dumped, and they dumped into a market where Chinese traders were already stepping back to prep for Lunar New Year. Liquidity in Asian hours was thin. The result, the crash started in Asia, where there was nobody on the other side. It accelerated in London. By the time New York opened, it was all-out carnage. Comex saw 1.8 billion ounces of paper silver trade in one day, more than 2 years of global mine output. Most of it opened and closed in the same session. That's not supply and demand. That's dumping paper to crash price and exit. Classic smash and grab. Now we're about to do a longer, slower version. 8 days where Asian liquidity isn't just light, it's gone. If somebody wants January 30th, but with more time, this is their window. Segment 4. 8 days of paper versus no physical backstop. With China offline, the global silver market fractures into two realities. In the West, price discovery migrates almost entirely to London LBMA paper forwards and Comex futures. You're trading contract against contract, algorithm against algorithm. In the East, physical buyers are forced to the sidelines. They literally cannot show up on the main exchange. What that does to the tape. Spreads blow out. Gold spreads can widen from $1 to $2 to $5 to $10 an ounce. Silver spreads jump from 10 cents to 50 cents or more. Slippage becomes brutal. In a normal market, a $50 million order might move gold $5. In this environment, the same order can move gold $20, $30, and silver by multiple dollars. Algorithms see thin order books, wider spreads, less depth at each price level. So they front-run big orders, trigger stop losses, cascade margin calls. This is the setup that produced a 35% one-day silver crash on Jan 30, a 7% silver spike in 4 hours on the CPI surprise Friday, from $74 to $79 on unremarkable volume, simply because liquidity was thin and buyers couldn't find enough willing sellers. In other words, the structure of this week guarantees overreaction. Every move, up or down, should be multiplied by 2 or 3 compared to normal weeks. For silver, that means a $1 to $2 move that would be routine in deep markets can turn into a $5 to $10 move in minutes. A $100 million order in a thin tape can fling silver $10 in one direction. This is not the week to pretend you're smarter than the bots. Segment 5, Day-by-Day Silver Playbook. Here's how this 8-day blackout looks specifically through a silver lens. Monday, Feb 16. Last gasp of Asian silver. Hong Kong and Singapore run half days. Last real Asian trading before the blackout. Silver is still trading with China in mind. What to watch? Does silver spike above $81 early? That's Asian players front-running a potential March squeeze. Does silver dump back towards 76, 77? That's pre-holiday de-risking. Traders saying, I don't want to be long into a vacuum. Also look at Shanghai gold premiums versus London. If Chinese gold trades at a $20, $30 premium, that tells you physical demand is strong and they're soaking up metal into the shutdown, which indirectly supports silver as a monetary hedge. 2 Feb 17, Mon Feb 23. Full blackout, silver in the danger zone. Mainland China completely offline. Silver trades as a Western paper product, not an East-West physical market. The big catalysts inside this window, WED, Feb 18, FOMC minutes. Normally, gold might move $10 to $20 on minutes. Silver maybe $0 to $50, $1. In this environment, gold can swing $50, $100, silver $3 to $5 on the same text, simply because books are thin. Thu, Feb 19, initial jobless claims. Bad number, claims spike. Rate cut narrative strengthens. Gold and silver rally, but overshoot. Good number, claims drop. Economy strong narrative. Metals sell off, but oversell. Everything is exaggerated. Silver becomes a leveraged bet on order flow, not fundamentals. Fry, Feb 20. Hong Kong comes back. Silver gets an Asian verdict. Hong Kong reopens while Shanghai is still shut. This is your first Asian opinion on whatever madness happened during the blackout. If Hong Kong bids silver higher on open and holds it, that validates the prior week's rally. If Hong Kong sells into a Western rally or buys into a Western crash, that tells you Asia disagrees with the price action and sees an opportunity. Satsun, Feb 21-22. Quiet on screens, loud in the plumbing markets are closed, but this is when you check the plumbing. Comex inventory reports. Is registered still bleeding at 785K a day? Open interest in March. Are weak hands bailing or are longs stubborn? Physical premiums at dealers, are they widening, physical tightness, or easing, some supply relief? Mon, Feb 23, last day without China, silver coiled. 4 days to Feb 27 first notice. Expect traders rolling March into May, July to avoid delivery risk. If March open interest drops sharply, the squeeze narrative weakens, less real delivery pressure. If open interest stays high or even rises, the squeeze is still on and the risk of a delivery crunch grows. 2. Feb 24. China reopens, silver tells the truth. This is the moment of truth. If Shanghai comes back and buys silver and gold aggressively, that validates the bull case. We can see silver launch toward 84, 85 quickly as Western paper has to reprice to Asian reality. If Shanghai sells into $5,000 gold and $78 silver, that says we're not chasing here. It undercuts the squeeze narrative short term and points to more consolidation or another flush. Segment 6. 3 silver scenarios: consolidation, squeeze, or redux crash. The video breaks the week into 3 paths, all of which end at the same place: March delivery. Scenario 1, orderly consolidation, 40%, silver chops between $76 and $81. Volatility elevated but not insane. FOMC minutes neutral, jobless claims in line. Hong Kong validates the range, China returns without blowing it up. Result, we march into Feb 27 with tension intact, Comex still stressed, but no fireworks yet. Scenario 2, bullish breakout, pre-squeeze, 30%. Friday's CPI momentum carries. Silver reclaims the 50-day EMA around $81 and spikes to $84.85. FOMC minutes hint at faster cuts, jobless claims worsen, real yields fall, dollar softens. Physical buyers front-run March delivery, and Asia, Hong Kong plus then Shanghai, buys the breakout. Result, we hit Feb 27 with silver already high, delivery demand elevated, and Comex facing a real test with sub-100 NAD registered. Scenario 3, flash crash redux, 30%. Thin liquidity gets exploited again. Somebody dumps size in Asian hours while there's no Chinese bid. Algos pile on, stops cascade, margin calls hit. Silver breaks 76, then $74 and can trade down into the 72-74 zone or worse. FOMC minutes come out hawkish, jobless numbers strong, dollar spikes, Hong Kong sells, China returns cautious. Result, weak longs are obliterated, open interest collapses, and Comex survives March with less delivery pressure, but only because the shakeout was brutal. The key idea, there is no gentle middle path when liquidity is this thin. Either we grind sideways with everyone nervous, or we get a violent move in one direction. Segment 7, how a silver stacker survives 8 days of chaos. Now the part that actually matters if you care about silver, not just a thrill ride, the structural bull case has not changed. Comex around 103M registered versus 400 to 500 malers of March paper claims. Inventory draining 785K Osatsday. 6th straight year of structural silver deficit on the industrial side. China hoarding refined silver and restricting exports with the 80-ton rule, 1.8 billion ounces of paper in a day on Jan 30. Proof the paper system is stretched and fragile. But this week is not about fundamentals. It's about order flow in a vacuum. So, if you hold physical silver, do nothing. This is not the week to outtrade algos. Don't sell your metal into a paper panic priced by traders who don't even touch ounces. Reevaluate after Feb 24, China back, and Feb 27, first notice, when we see if anyone actually stood for delivery. If you trade futures or leverage paper, cut position size by 30-50% minimum. Widen your stops or consider no tight stops at all. In a gap-happy market, tight stops just guarantee you sell low. Think about using options on silver instead of outright futures. At least then your maximum loss is the premium. Do not hold huge positions overnight from Feb 17 to 23 unless you can eat 5 to 10% gap moves in one shot. If you trade SLV, which are silver miners, expect wider spreads, maybe 0.10, 0.20 on SLV instead of 0.02, 0.03. GDX, SIL, and individual miners can swing 3 to 5% in a day on nothing but ETF flow. Size down. This is not the week to YOLO into juniors. The edge is not guessing which scenario plays out. The edge is survival, still having your capital and your metal when real price discovery resumes. Comex at 103M registered. 8 days without China, 12 days to first notice, 35% crash 3 weeks ago still echoing. That is a powder keg. It might fizzle, it might explode. Your job is not to be the fuse. You've been watching John AG here, and I'm OG John AG. If this helped you see why the next 8 days are about silver structure and liquidity, not just red and green candles, hit like so this kind of deep dive doesn't get buried in the noise, and subscribe with all notifications on, because when China comes back and March delivery hits, I want you watching the vault math, not just the price on your screen.